Hello, this is Dr. Phil Rosenkrantz, and I'm responding to some YouTube videos I've seen regarding Dave Ramsey's recommendations for home loans, specifically to get a 15-year loan, not a 30-year loan, and make sure the payments are less than or equal to 25% of your take-home pay. So I've seen a lot of comments both for and against it, and I think that looking at the numbers is helpful, and I want to kind of take a deep dive into it and show you what the numbers are, and then kind of clarify my thinking on this, or at least share it with you. So anyway, I'm going to share my screen and look at the actual numbers. And I want to comment that I'm not going to do a big job of editing this. I just want to get it out. So please bear with me. So what I've done here in the upper left-hand corner is use 3 different home values, because in different areas of the country, prices vary, of course. I live in Orange County, California, and here it's very high. If you want to buy a starter home in my neighborhood, you're lucky if you can get it for $800,000. But then again, some neighborhoods nearby, you can do that. But I also am looking at a $500,000 home and a $250,000 home, which you can find in a lot of places around the country that are not in California or New York. So anyway, I just used these just for demonstration purposes. I also used a 20% down payment. Now, why did I use 20%? I used it because if you put a 20% down payment, then you avoid making PITI insurance payments. What is that? If you have less than a 20% down payment, the lender wants to get some insurance that covers them in case they have to foreclose on the house and it has depreciated in value a little bit. But with a 20% down payment, they've got a big cushion. With less than that, they have less than a cushion. So you're paying hundreds of dollars a month for that insurance. And it's not insurance for you, it's insurance for the lender. So I use 20%. That means the third line that you'll see with my cursor is the loan amount. And for a 30-year loan, we have 360 months or 360 periods. Now, for 30-year and 15-year loans, they typically have different rates. And I would say roughly the 30-year loan has a 1% higher, roughly, interest rate than the 30-year loan. And I just grabbed today, first thing I saw online for interest rates was a place called NerdWallet. And I don't know who they are, but I looked down the line at some of the others and it wasn't much different. And it was 6.828% interest for a 30-year loan today. And I saw some a little less than that, but I'm using these numbers for purposes of this. Now, using Excel functions, you can find out all kinds of stuff. And so the monthly payment for a $200,000 loan is $1,307.58 per month. And then I also got the loan payments for the $400,000 loan and the $640,000 loan. Now, this is for a 30-year loan. And to the right of that, you can see the actual month-by-month calculations for how much of the payment goes toward interest and how much then the rest goes toward principal. So these two columns show that. For example, in the first month, you have the $1,307 payment, of which $1,138 goes to interest and $169 goes toward your principal. So that means that you're not really reducing your principal very much in these early months. What I did was, to demonstrate that, I showed at the end of year 1, you will have paid $13,300 $591 in interest and $2,099 in principal, percentage-wise, in the first year, 87% of your payment went to interest. So you didn't really gain much equity in the first year. You probably, if you gained any equity, it was probably if the value of the property went up. But you can see here that with a 30-year loan, you're paying a lot of interest and very little principal all throughout the early years. So then I did the same calculations for the $400,000 loan and the $640,000 loan. And the percentages are still the same, but I have a table where I'll be summarizing this a little later. But this is what the numbers look like. For example, on the $400,000 loan, interest $27,000, principal $4,000. Let me move on. I've done the same thing for the 15-year loan, but the interest rate is 5.998%. That's almost a percentage point lower. And the monthly payment, the $200,000 loan, is $1,687. For the $400,000 loan is $3,375. And for the $640,000 loan is about $5,400. And now let's take a look at the percentages of interest and principal for the 15-year loan. In this case, for the first year, you're paying $11,765 in interest and $8,484 in interest. Now that's 42% toward the principal, 58% toward interest. Now, that is a significantly different percentage than with the 30-year loan. 13% toward principal versus 42% toward principal. Let me go to a summary table and we're going to compare these. So I have that over here. Hold on. Let me make that a little bigger. Okay. Now, for these three different home values, the difference in total interest between these three, the difference in interest paid for the lower priced loan is $166,980. That's the difference in interest paid over the life of the loan. The difference in interest for the $500,000 home, $333,960. And for the $800,000 home, it's over $500,000. That's interest paid that went to the bank. It's out of your paycheck. It's not your money, and it's gone. Now, that's the difference between the two. So this is why Dave Ramsey is so rabid about the 15-year loan versus the 30-year loan. It's the total amounts of interest that you're paying are so much different. So that's what he's talking about. But I think what other people are saying is when you're talking about you want to have a loan payment less than 25% or equal to 25% of your take-home pay, that's when people say, well, that's unrealistic. I can't do that. And that is because it depends on where you live a lot and also what your salary levels are. And a lot of times that's based on the cost of living of where you're at. And so let's take a look at that for a minute. Here, I've listed the 30-year versus 15-year payments. And for the $250,000 home, the difference is $380. And that's not that much of a stretch to go ahead and go with the 15-year versus the 30-year. But if you're in a $500,000 home, now you're talking about a $760 a month, or the $800,000 home, that's $1,216. Now, let's look at what your monthly take-home pay would have to be if that's 25%. So your monthly take-home pay for the $250,000 home would need to be at least 5,230 for the 15-year loan, 6,750. And so, you know, what does that mean annually? Well, that's a $62,000 take home or $81,000 take home. And so, a lot of people are in this range, depending on what you do for a living and where you live or your cost of living. But then when we get into the $500,000 home, a $10,000 a month take home, which might be realistic for two incomes, and the 1350 might still be realistic. The total annual take homes for those two is 125,000 or 162,000. So now we're starting to get to the point where you may not have that kind of a total take home pay between two incomes. And then when you get to the $800,000 home, it gets a little bit more, of course. And you're talking about a family take home pay of 200,000 versus 259,000. So this is what I think a lot of people are criticizing, is that this 25% rule is kind of unrealistic, or they just can't do that. So let me go on and throw in some more information here. The county that I live in it's Orange County, California, which is really an expensive place to live, but also salaries and things are higher, but rents are high too. Now, I copied this today from online. These are average two-bedroom apartment rental costs. And for example, New York, 5,400, Los Angeles, 45, and then Chicago is over 3,000. San Francisco is about 4,000. A relative of mine just rented a two-bedroom apartment in Orange County, and it was 3,400. These rents are pretty high per month, and you'll notice that a $500,000 home monthly payment for 15 years is $33.75. So if you can get in to a home, if you can scrape together the down payment and get in, your monthly payments may actually be lower than what your rent is, depending on where you live. The beauty of paying a monthly payment on your home is that it doesn't go up like rent will. And Dave Ramsey's commented on that, how rent will keep going up and it'll never come down. And if you ever retire and you're paying rent, you could be in a little bit of difficulty. Let me point out one more thing. And first of all, let me say I'm totally in favor of 15-year loan compared to the 30-year loan, because those total interest payments just blow my mind. I bought my first home in 1975, my second home in 77, I bought a rental in 77. Since then, I've added on to my home. I've refinanced it a number of times, and I have a couple of other homes I own, one with a 15-year loan, one with a 30-year loan. What is an in-between option is, let's suppose that you get into a home with the lower payment, the 30-year loan. And maybe that really kind of a necessity if you're trying to use that 25% rule. So here's a couple of options. One is that whenever you can, you make an extra payment toward the principal. And what that does is, by adding to the principal, you're cutting off extra payments at the end. You're reducing it from a 30-year loan to a 29-year loan or to a 28-year loan. And then that helps you get it paid off early. That saves you a lot of interest. Once you get your house paid off, you don't have any loan payment. And so if you're 35 years old and you get a 15-year loan, your house is paid off when you're 50. And for the next 10 or 15 years before you retire, you're able to stash money into investments and into generous giving. So let me illustrate that a little bit. What I did here for the 30-year loan was I created another column where I added an extra little bit to the principal each month. So I did it for 100 extra a month, 200, 300, and 400 extra a month. And over here, if you can see it on the screen, I'm circling it. I've created how many months you would be making your payments if you gave an extra 100, 200, 300, or 400 and then converted the months into years. So if you put an extra $100 a month toward the principal, your 30-year loan drops to a 24-year. If you put in an extra 200, it gets down to a 20-year loan. An extra 300, 18-year loan, and 400 is a 16-year loan. Maybe you can't do 100 every month or 200 every month, but let's say that, some months you put 200 or 300 and some months you don't put any. The point is that if you average these, you'll reduce the number of years. So that's option number one, is to consider, after you get into your 30-year mortgage, making extra payments on the principal. But here's probably the most likely thing that will happen, and this is what I've done a number of times, is when the interest rate, and by the way, my first home loans back in the 70s were up in the 7% range. What I did starting about 15 or 20 years ago, when the interest rates started dropping, I refinanced the house, and I ended up refinancing and getting 15-year loans, making the same payments as when I had a 30-year. And then my last time I refinanced my main house, I got a 10-year loan for 2+something%. So I was paying almost all principal, and then I finally got it low enough I just paid it off with a chunk of money. And on my other two homes that I own, I refinanced one at 2.25% in 15 years. But before I could refinance the other one, which I had already refinanced once, all the interest rates went up. So that one I'm at 3.3%. But anyway, I hope you'll find this helpful. I think what Dave Ramsey was rabid about was the huge amount of interest that you pay on a 30-year loan. And also, he doesn't want people to get stuck with the loan payments that are 50% of their salary. And I bet you I have neighbors that are doing it. Just wanted to put the numbers out there, let the numbers speak for themselves, and hopefully you'll find this to have been helpful. And if somebody wants to duplicate this on Excel and they find a mistake on what I made, I apologize. I didn't do a big job of double checking everything. Feel free to somehow let me know. Let me add, I've been teaching this stuff to engineers. This is a finance course for engineers. I've been teaching for 42 years. And so I've been working with these numbers a lot. So I thought I'd slap this together, and hopefully you found this to be interesting. Okay, good luck. Thank you.